Hello and a warm welcome to Talking Stocks. I'm Kukudetu Tsele. Also in studio with me every week, we are joined by Peter Armitage as well as Sean Ashton, both from Anchor Capital. Now, they are the experts, and every week we'll bring you their insightful analysis into JSE-listed companies. Now, this week we take a look at the world's second biggest furniture retailer, Steinhoff International Holdings. The retailer has over 500 stores. It manufactures and retails furniture and household goods in Europe, Africa and Australia. Gentlemen, good to have you with us as always. For some viewers out there scratching their heads, Steinhoff, who are they?
So Steinhoff is an integrated furniture retailer and manufacturer, largely based in Europe. It's not a South African business by and large. I mean, it's listed in South Africa, but more than 80% of the profits that they derive are actually out of their operations outside of South Africa. And there's some smaller associate investments in South Africa, but by and large, this is a European business.
Maybe for the South African consumer, they might be more familiar with JD Group from a retail perspective. But let's touch on that geographical split with you, Peter, the European contingent as well as some other retailers out there.
Yes, I think Europe dominates. It's around 80%. We've got some graphs in it. And there's a relatively small business in Australia. And the share still actually moves quite a lot with what happens with South African furniture retailers. But JD Group, depending on how you measure it, is well below 10% of their earnings.
Maybe if we do take a look at just the split that we've got behind us here, we've got CAP as well. Some investors might not be too familiar with that. PSG Group, a well-known investment firm there. So quite a lot of players involved here too.
Absolutely. I think a lot of these relationships also come about through cross-holdings from a directorship point of view that these companies have in the Stellenbosch crew, if you want to call it that. So as a result, the 17% holding in PSG might come across as odd. They describe it as a strategic investment. I don't think that there's necessarily huge cross-pollination of business opportunities, but nevertheless, that's a business which obviously has grown quite nicely, and they have a stake in that.
Just out of interest, we're always talking or referring to Europe, which is the strongest region that you mentioned there, Peter. Many people have concerns about the growth there.
Yeah, I think the Steinhoff story is one of valuation and the moves that they're going to make over the course of the next few years, rather than being terribly excited about Europe. I think, if I was to leave Earth for 5 years, as we always say in our business, I wouldn't be invested in European retail. There's aging populations, but as we'll show you during the course of the program, they've bought some businesses, they're changing the mix, they're very good at buying businesses and changing the performance of them. So something like Conforama in France, which was their latest big acquisition, they've had a massive impact, but largely by changing the mix of their business. So we think there's quite a nice growth trajectory for the business out of what they're doing within the business, rather than the macro picture being that positive.
Explain their model for us just a little bit further. You mentioned the buying, being acquisitive, and then changing the structure of the company.
So Steinhoff, they're basically deal makers and guys who've been out there to make some money. The skeptics, if you go and look at their annual report over the course of the last 10 years, many changes in stated strategy. I think they've been very nimble. This comes back to the roots of Marcus Jooste, was the financial director of Goma South Africa. And they've grown into a business which is only beaten by IKEA if you look globally. And what they started off doing was doing quite a lot of manufacturing in kind of Eastern European areas, taking advantage of lower costs and currency. And they were largely a manufacturer. They then, as the low costs moved to China, they've opened up a sourcing plant there, well, a sourcing business. We visited them a few years ago. And so they're basically getting the best price from wherever they can in the world for the sale of their product. And they've gradually migrated that into, in fact, owning the retail footprint in Europe. And they've bought up a business that was liquidating in the UK. They've bought up a number of businesses in Germany. They've bought the biggest player in France. So now they've got kind of an integrated model where they're both manufacturing and sourcing the material, and then on the other side actually retailing it.
Well, Peter, you've mentioned Marcus Jooste, and speaking of Marcus Jooste, he is the chief executive of the firm. And here's his take on furniture and the retail space for investors and consumers locally in South Africa. Let's take a look.
South Africa, with the Abel and the Illerines incident, which is not good for the country, is obviously made investors nervous, especially overseas investors, of which we now have a lot after our foreign capital raising for Steinhoff and the country. So I wasn't too perturbed by it because I think it's fair for them to have been nervous about what is coming. Hopefully we've provided them with a set of results that would comfort them in total. But by the same token, it's never nice to have invested in a subsidiary that must write off a lot of money, which we had to do. But you know, when we took over, we took immediately the steps that we had to take. The books have gone backwards in the last 12 months, 6 months increasingly, so it is a problem in the country, and specifically the type of credit that might have been granted in 2011, 2012. But we've taken the corrective measures. We've now sold the book to a very big international consumer finance house, and I think it's great for the country.
Well, there we have it, him commenting about the tough environment locally in South Africa, but it almost seems as though Abel's had its issues, Sean, but JD is not doing too well either.
I think there's an important thing to understand about JD Group. It's not just about the consumer finance business. Now, obviously, as Marcus mentioned, they've sold off the actual debtors book, so you're left with the retail business. But the majority of where the money is made in that business is actually Unitrans Motor Retail, which continues to perform reasonably well. And I think that's a point that's often missed by investors in JD Group and Steinhoff, is that it's not just about the furniture business. I think they do have the opportunity, of course, to consolidate that space, and I think selectively they may look to. I think the issue of African Bank's failure and the fact that Ellerins is obviously placed under curatorship creates an opportunity for the rest of the industry to gain share. But ultimately, I think that industry needs to be restructured, and things need to happen a little bit differently. You know, consolidation of store numbers, probably bigger store sizes and aggregate, better stock turns. And I think that JD Group and Steinhoff is probably a business through their global sourcing that's quite well placed to lead that process.
You mentioned global. Again, we come to the overall European story, and it does seem as though there's a property underpin there too.
Absolutely. Yeah, so when you look at the European business, as we mentioned in the first slide, about 80% of the group's profit is Europe, of which the vast majority is offshore, of which the vast majority is Europe. And within that number, about 25% of the earnings generated out of the European operations is actually rental income out of the properties that they own. So they own substantially all of the retail properties and the distribution assets associated with their European businesses. There's about 4 million square meters worth of property that they have there, and at cost it's about 3 billion euros worth of asset on their balance sheet. But that undervalues the real value of these things, because they acquired a lot of these properties when the markets were a lot lower than they are now. And if you just look at the income generated out of those businesses divided by the actual asset value, you're looking at a yield of probably 7 or 8%, which is too high. I think a market-related value is more like 5% if you were to capitalize it like a property company. And that would result in a substantially higher valuation for the business. Probably a quarter of the value of the entire group would just be property.
I want us to get into the valuation in a moment or two, but speaking about that property underpin, Peter, is this a unique strategy for this business?
I think it's not so much, well, they've had a view that they want to own the properties, but they've bought a lot of 80, 100, 120-year-old family-owned businesses, and they've tended to build up a property profile over time. So when they've bought businesses like Kekelina, which was in Central Europe, they inherited things like a Belgium head office. They've inherited things, big tracts of land where the actual retail store, there's a lot of vacant land on it. So there's a lot of, besides the actual valuation, there's a lot of development opportunity. So you're going to see them announce, we think, well, they've actually said it, their last presentation. They're going to announce a joint venture, we think, with a South African property company, who they know very well, to unlock this value. So there's part of the story, and we talked about the Steinhoff story not being a big macro growth story. It's about increasing margin in the furniture business and property unlock, which we think is largely unappreciated by the market.
Well, that was uncovering Europe once more, but back to the JD story. This is what Marcus Uester had to say about the JD Group had they acquired that company sooner. Let's take a look.
I would have now had the retail job done in terms of renovating the house. But listen, one must never look back or try to look clever. We must deal with the facts on the table now. People has the prerogative to do what they believe. But now this time around we have the opportunity, and with 86% of the shares we are putting all our efforts behind JD.
All their effort behind JD. Maybe to come back to you, Sean, we have revisited the JD story. They have sold off the debtors book there, but from your perspective, could things look towards the upside?
I think certainly there is probably some upside in JD Group, but that's, for me, that's a little bit peripheral to the overall investment thesis of Steinhoff itself. I mean, when you're buying into Steinhoff, it's certainly less than, it's probably 5% or thereabouts of the value of the business. So to me, yes, I think there's some upside in that business. I think the potential to improve the furniture profitability is there, but that's certainly not the reason that you invest in Steinhoff Group.
You touched on valuations earlier. From a valuation perspective, as you say, is it looking fairly expensive?
Look, I think it's increased significantly in value, but off a very, very low base. I mean, we first invested in this company about 18 months ago at about 23 Rand a share.
Sure, you were lucky.
At the time, it was a forward 6 times P multiple. So the market hadn't appreciated the Rand depreciation and the fact that Conforama's margins were coming through quite nicely. So I think that the earnings power of the business was not fully captured in consensus expectations. The share price has more than doubled since then, but still trades at a forward 11 PE, which is a substantial discount to the broader industrial market in South Africa. And if you just look at the stack up of valuation as we see it, if you capitalize their property assets at a 5% cap rate in Europe, that's about 22 Rand a share or so. There's about 12 billion rands worth of debt in the business post the capital raise, which is obviously a negative 4 Rand. And then we think the furniture operations in Europe, you could probably value at about a 13 PE. JD Group is let's say 2 Rand a share. CUP and PSG are fairly small in the mix as well. So we see that when you stack things up as a sum of the parts, you can get quite easily up to about 67 Rand a share of value without being too aggressive on your assumptions.
Still trading at a discount from what it seems. Just to close off with the Frankfurt listing, should that play any influence on investors' decisions?
Look, I think it potentially brings in a different type of investor. You might have more European institutions that previously wouldn't have invested in the stock, investing in the company. I'm not sure that it's a big positive at this point in time, and it probably hasn't happened as quickly as people would have expected, given how poor markets have been in Europe specifically in terms of valuations on the DAX. So I think that I wouldn't expect to see an immediate 20% uplift in the share price just on the basis of a listing in Frankfurt. But ultimately we still see pretty good value in the share. And when you look at it relative to South African industrial businesses as a peer, although the share price has more than doubled over the last year or so, it still trades at a 30% discount to the average industrial business in South Africa as measured by just the industrial index.
Exactly.
And that's been a discount that's been fairly consistent over time. It's just that it was a much deeper discount a year ago.
Well, that brings us to the all-important question where the experts tell us now whether to buy, hold or sell the stock. Peter, buy, hold, sell?
Buy. I think there's a pretty good chance the stock will be 70 Rand in the next 12 months.
70 bucks. What will push it there though?
I think a combination of some property news, an appreciation of the valuation, good results, and probably a Frankfurt listing.
The investment outlook?
Much the same. I think when I look at a year out, 70 Rand is definitely a number we'd have on the cards. And that's about more or less 20% upside from here. So
This is one in your portfolio for the long term?
Certainly, it's one of our bigger holdings.
One of the bigger holdings. Well, that's where we get the comments from. So it's certainly a buy, one for your portfolio. And that's where we leave it for this week, I'm afraid. But do catch us again next time where we talk more stocks.